All right, guys, good evening to everyone. Welcome back to the Independent Investor Channel. This is kind of a staple on the channel where I jump in and I provide some level of insight to how the portfolios are reacting to the volatility over the last couple weeks in the stock market. Obviously, we've gone through a little bit of a rough patch, but for you guys that are not invested, honestly, this is real talk. This gives you a more holistic idea of what the stock market can deliver from month to month or year to year. I am a long-term investor, certainly. I've evolved in my philosophy and strategy over time, I believe for the better. This is a mix of passive investing and dividend growth investing in this portfolio. This is my self-directed Roth IRA account number one. I'll be rolling out a follow-on video on number two, but this is actually my flagship account here. And this is very, very useful for anybody that is interested in the stock market to sit back and actually see what a real portfolio looks like, and especially how it's reacted over time. I do want to, obviously, you can see for yourself what is obvious in this account is that we're dealing with and suffering from some loss. It wasn't about a month or a month and a half ago that I hit 100,000 in this account for the first time. That was relatively short-lived. No problem. I still give myself credit for making that milestone in this portfolio, and I have no doubt we'll be back there. This portfolio suffered from a little bit of a double whammy, and I'll just start from the worst of the worst, and that is my exposure to energy through ExxonMobil and through Royal Dutch Shell. Obviously are really kind of in the gutters right now. I do foresee those turning around over time, and we'll just have to wait those out. So those are the obvious laggards in the portfolio. Obviously, Boeing kind of sticks out here with FedEx is kind of having it rough. And then you start to add in some of the anything that's associated with travel and leisure here in the portfolio. Disney really sticks out as they are at least partially tied to some level of cruise exposure there. But what you don't see in this portfolio, certainly you guys will be interested in focusing in on the dollar change and the percentage. Obviously, this is it's ugly, right? And that's just part of the gig. You can kind of come down here and get your percentages of loss at this point. But what I want to highlight here is the stuff that is perceived out of this portfolio from my perspective. And I think a lot of people will watch this video, and usually when the volatility kicks up, I usually have a lot of people who come onto the channel and tell me things like, run for the hills, the stock market is crashing, this is not a time to be invested in stocks, blah, 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 this and that. And I've had that type of engagement, especially over the last 3 years on the channel, and it does go beyond that, as I've been an investor for a really long time. And it seems like when volatility kicks up, there seems to be a lot of experts that aren't really invested at all in the stock market that always want to say their piece about what they think about how bad the stock market is. The irony in that is that this is not the first time the stock market has gone down. It has gone down many, many times in its history, and each and every one of those times has proven to be a wonderful buying opportunity. So I do think there's a couple different schools of thought here. Certainly, if the stock market isn't for you, wonderful. I'm not going to try to talk you into it. I just find it ironic how a lot of people try to talk you out of it. And I guess I have a hard time wrapping my mind around that, because I've already justified this as being really the single greatest way of building out your assets bucket. What I mean by that specifically is there's very few things that you can buy in life that you can put into an assets bucket and demand of that assets bucket to pay you consistently. And this portfolio, if you pay particular attention to the underlying strengths in the portfolio, we've got about 11 Dow components in this portfolio, as we do in the other one. There's going to be dividend payouts in this portfolio in each and every one of these names. Again, I separate the high growth, non-dividend paying stocks in another area of my comprehensive portfolio. So this being my Roth IRA, I'm very, very careful in making sure that I'm always getting paid some level of dividend payout in this. And each and every one of these stocks I look at as a small business. As small as these payouts are, every single quarter and every single year and every single decade that is going to go by over my life, these assets are going to generate wealth in the short term and then compound on themselves over the medium and long term. So even though in the short term you can look at this and say, wow, this is a very ugly portfolio, Ryan, I don't understand why you invest. Look at it from my perspective. It's really quite unfair to look at a portfolio in a downturn, and it's also unfair to look at a portfolio when it's sky high and say, wow, this is the greatest thing ever. I want to get involved. How do I get involved? Those two extremes I typically don't pay a lot of attention to, as my focus on this portfolio, as well as all of my wealth, is built for the future. That's it. So if you want to come back to me and say that you think that companies like Coca-Cola and McDonald's and Home Depot are going away, I'm certainly open to hearing those arguments, but I certainly do not buy into that, nor do I believe that line of thinking. So the real takeaways here is to understand some of the strategic moves that I've actually made. Reestablishing a position in Citigroup. That was a stock that I sold in January for a very, very large profit. So that profit was rolled into cash, and then I've reestablished this position here at these lower prices. Now, obviously, I didn't get it perfectly, but I did take those profits. And the question is, how many of those shares did I buy with that cash that were on house money and not with hard contributed dollars? That's the real key. I took a double up position in Caterpillar. I added more to my Disney position. Home Depot I left alone. Johnson & Johnson I left alone. Kimberly-Clark was a new position, but I did double up in that. I believe the initial position was 15. We added 10 more to it, and Kimberly-Clark has really held up nicely in this downturn. I know Coca-Cola was one of those that I took an additional position in. McDonald's, I believe I've held true. Microsoft was an addition into the other portfolio, as I hold Apple in this one and I hold Microsoft in my wife's. So the two big positions there in the technology sector, I actually split those up so each of the portfolios can have equal representation to what I feel are the best of each sector. But rolling down the list here, United Technologies definitely added to that position, obviously has suffered. But the real key takeaway here is to understand how I've increased my share base in the first column of quantity here. This is the third column from the left, working right. If you look at some of these share bases, these have absolutely improved over this volatile time, especially the larger position that I have in my VYM, which is here. This is VYM. So 242 shares. This one just paid a huge dividend to me. As a matter of fact, these Vanguard ETFs, when they all pay at the same time. So I just had an excellent payday on the dividend side of the house. And this might not be something that a lot of YouTube creators will focus on, but in the course of volatility and looking at the capital depreciation here, it's certainly nice here to acknowledge that these are still working the way that they're expected to work. And then Walgreens, which was a new position, and ExxonMobil here finally I talked about at the top of the review. So with that, guys, I'm going to continue to roll these out and provide you transparency. We'll see how the portfolio fares over the coming weeks and months as we either flush this out or we continue on a depreciating graph. Whatever it is, we're prepared to do so. I always say when we're building these portfolios out to make sure that you have as much quality baked into the portfolio as you can. That makes these volatile times a lot more easy to stomach, because there's not a lot out there on the landscape that I feel are better quality positions than the ones that I've been able to piece together, especially between these two Roth IRA accounts that I have. So guys, don't forget to subscribe to the message. Leave your comments at the bottom of the video. Bring anybody that you know onto the message that you know might benefit from this information. Somebody looking to get started in the market. Honestly, if they looked at a video like this, they may have second thoughts about it. But certainly my perspective and making sure that the focus is where it needs to be, and that's on the quantity column and not necessarily on the dollar column or the percentage of change column. Guys, thank you so much for tuning into the video, and good luck in your investment future.